repurchase agreements and principal agent relationship. We need to identify principal agent relationship to determine who will recognize gross revenue and who will recognize net revenue. Principal agent relationship is also known as gross or net amounts or gross or net revenue. Different terminologies used for them, gross or net revenue. Can you give me an example of principal agent relationship? Now the conditions are, the indicators are discretion to establish prices, control of goods or services, or performance or responsibility to deliver, who is responsible, what could be other reasons for it, and who bears the inventory risk of inventory. So whosoever has discretion of establishing prices, whosoever is controlling and responsible for fulfilling and bears the risk of inventory will be recognizing gross revenue. The other party will only be recognizing net revenue. The best example is case of Amazon or Flipkart, wherein they are not holding any inventory. The third parties are establishing their prices. The sellers on the Amazon and Flipkart are establishing the prices. They control goods or services, are responsible to deliver. They bear the risk of inventory. The medium is simply earning net revenue. So they cannot recognize gross revenue. They'll be recognizing only commission or brokerage for facilitating sale as revenue. This is an area which is very controversial because entities recognize gross revenue to show their revenue is very high and recognize heavy cost. So the revenue figure is very much inflated because of not being able to comprehend between gross or net, or not being able to define whether it is principal agent relationship. So this requires a lot of attention and classification, that the entity cannot recognize gross revenue because they are simply an agent. If they are principal, they will be eligible to recognize revenue as gross amounts. A lot of comprehension requires a lot of controversial area. Need to read the contracts between customers and buyers very carefully, and then need to define that who is actually establishing a price, who has the rights to deliver, who is responsible, who bears the risk. These indicators help us to determine whether the party is principal or agent. Next comes repurchase agreements. What are the scenarios in a repurchase agreement? The customer has the right to repurchase. Customer is obligated to repurchase. What can be the third scenario? Customer is required to repurchase. By the buyer. When will a customer has the right to repurchase? When it is required to repurchase, when it is required to repurchase, the ball is in the other person's hand. So it is considered as a put option. Has the right to repurchase, there is a call option. They can purchase, they may not purchase. And when there is an obligation to repurchase, this is a forward contract. How to deal with them? When the customer has the right to repurchase, when the customer has an obligation to repurchase. If the original selling price is 700,000, fair value of the same asset in the market today is 7,50,000, and customer has a right to repurchase it at 6,50,000. What is it? Will the customer exercise the option? Why would you enter into an arrangement wherein you are receiving 700,000 today, and for taking control of your asset again, you have to pay 650? Why would the other party bear this 50,000? Why they'll be interested in it? And if on repurchasing, you are paying 740,000, why would you pay more? Repurchase price is lower than original selling price. First scenario. Second scenario, repurchase price is higher than original selling price. Just think through it, that why would you accept a lower amount? And if you are paying higher than the original selling price, why would you be agreeing to pay higher amount to someone? What is the difference between two arrangements? In the first arrangement, you have given away the asset to use on the right of use, and you are charged for the right of use 50,000. You also got money for the time being, but you have paid back 650. That means the difference is actually a leasing arrangement with the customer. Repurchase agreement. It's not actually a sale. It's a repurchase agreement, which simply means that we are giving away the asset to the customer to use it, and customer bears 50,000 for it. So will it be considered? It will be considered as a leasing arrangement under IFRS 16. Leasing arrangement under IFRS 16, it will not be considered as a sale. Got it? The other party is bearing this 50,000 for using that asset, and they hand over that asset back to us when we pay them their money, when we pay them the differential amount, whatever we agreed. So this difference is actually the right of use which they paid over a period of time. Why we would pay more? In the second scenario, it may not be necessary that physical possession of the asset is given to them. It's not necessary. Why would we agree to pay more? We received 700,000, but on getting our right to own the asset or repurchase the asset, we have to shell out more from our pocket. Why we agree to pay more? Even equal, when the repurchase price is equal or higher than original selling price, what do you think? What will be this arrangement? Just think through it. Like, I want you to purposely think through it. So if you would have been in this similar situation, why would you enter into this kind of arrangement? If you needed money, no one was willing to pay money, so you have given something as collateral, security. You say that you can take away this if I'm not able to repay. And why you have to repay more amount? Because there's some significant financing component as well in it. So you're actually being funded by the other party. You receive 7 lakh, and you pay interest component onto it, 740, and you're able to retrieve back your asset. What is this considered? This is considered as a financing arrangement. So when you have the right to purchase or whether you are obligated to repurchase. So this is a right to repurchase. When you will exercise this right only when the price is favorable to you. If the price is unfavorable to you, you will not exercise this right. Agree or not? You will not exercise this right when the price is not favorable to you. If the price is favorable to you, exercise this right. When you're obligated to repurchase, in the second scenario, it may be a financing arrangement with the bank. They are not interested in your property. They're only interested in your interest component. So in these two scenarios, depending on what is the situation, whether the repurchase price is lower than, if the repurchase price is higher than the original selling price, you will not exercise this option. Agree or not? And if you exercise this option, you may be obligated to repurchase because you are actually entering into a financing arrangement with the customer. Is this clear or not? Hello. That you received 7 lakh and you are able to buy back that sold item for 6,50,000 because you have a right to repurchase. So this is in reality, in substance, it is a leasing arrangement. Otherwise, no one would allow you to buy the same thing at a lower price. Agree or not? Will you get someone in the market who would agree to it? That you sell something to us for 7 lakh and we'll sell the same thing to you for 650. Will you get such people in the market? Hello. Will you get someone who would like to get into this kind of arrangement? No. This is only possible only if there is a leasing arrangement. This is only possible when the substance of the transaction is actually leasing. So this is considered as a leasing arrangement under IFRS 16. In a second scenario, if someone is giving you 700,000 and they're demanding higher price for the same, and you're obligated to repurchase it at either equal or higher price, so that means they are not interested in the purchase of your item. They are more interested in the interest component, and they've indirectly funded you. If you enter into this kind of arrangement, this is actually a financing arrangement. You will record it as a financing arrangement, received funds, charge interest expense over to it, and you're liable to pay that amount to them. Agree?
In both the cases, fair value is not having any value.
Fair value has no significance in these cases. Okay. Fair value will have a significance in the third scenario when the customer is required to repurchase by the buyer. I purposely included it just to avoid confusion when I discuss customer is required to repurchase. In these scenarios, it is on the customer now to whether to get into this or not. So depending on comparison with price, so this is already decided, like when they must have got into this arrangement, they already knew what they're entering into. But they on the face, they are projecting it as a sale with the right of return. They're projecting it as a sale with the right of return. So inherently, we may not be able to recognize revenue, and this doesn't even form part of revenue. So how to recognize it? When we compare what is the purchase price, what is the sale price, if there is any difference, the difference why we would agree to repurchase it or why the other party would agree to sell it back at a lower price, because they have entered into a financing arrangement with us. Why we would agree to pay more was we are actually being funded by the other party, financing arrangement, and they both are in our favor. But what if the third party is required to repurchase? Then again, these prices will play a role. If the original selling price was 7 lakh and fair value of the same asset in the market is 7,50,000. Now in this case, does the customer has any significant benefit? And if they require the customer to repurchase, customer has the right to require the repurchase at 650 and fair value in the market is original selling price was 700,000, fair value in the market is 600,000. Now in this arrangement, now when we have this situation wherein we can repurchase when there is a incentive to us, we have the right to repurchase. We'll exercise this right only when we believe it is beneficial for us. So we'll exercise the right to repurchase. So in substance, in reality, it is leasing arrangement. If we agree to repurchase it at a lower price at which we sold. We received 7 lakh and we sold it for 650, means the differential is actually the leasing amount, the right of use amount. If we agree to pay more, and if we are obligated to repurchase, means the other party is not interested in the component which we have given away. They are more interested in the interest component. So we'll have to bear more. We are required to repurchase it at a higher price than we actually sold it. So this is clearly a financing arrangement. But what if the ball is in the other court, the customer? Depending on what situation the customer is, and customer can require us to repurchase. Now customer will require us to repurchase only if there is a significant economic incentive to the customer. So first scenario can be no significant incentive to the customer. There could be a significant incentive to the customer, and the price is lower than original selling price. Third situation, when the price is higher than original selling price. Definitely when the price is higher than the original selling price, this is a automatically inherent significant benefit to the customer. So depending on what situation the customer is in, whether they're getting some economic incentive out of initiating this sale or requiring the seller to repurchase, or whether they're not getting any incentive. If they'll get any incentive, they'll require the repurchase to happen. If there is no incentive, what they'll do? In the first scenario, if you see, the original selling price is 700,000. If they sell the same product in the market, they'll get 675. But if they require the seller to repurchase it, they'll get only 650. What they'll do? What do you think? What they're going to do in this scenario? If there is no significant incentive to the customer to get this, or they require the seller to repurchase it, if there is no incentive, if they're going to get a higher price in the market, will they exercise this option? Can we consider it as a sale, or shall we not? If there is no incentive to the customer to require us to repurchase, can we consider it as a sale? Because we know that they're not going to exercise this option with us. So they'll be getting, if they're getting higher price in the market, they'll sell it in the market instead of selling it to us. What do you think? Or do you believe that they'll still come back to us and will require us to repurchase it at 650 because we are bound to pay only 650, but the price in the market is higher? Though this is lower than the original selling price, they'll not require us. They paid us 7 lakh. They'll not require us to repurchase for 650 when they are able to sell it in the market at a higher price in the market. Now it is in their court. The scenario between this customer has right to repurchase, customer is obligated to repurchase. This is different from here. The other party has the option to benefit of possessing these rights. What do you think they'll do? Will they want us to repurchase or they'll ignore us completely? Will they want us to repurchase or will they ignore us? What are the chances? What are the chances? If there is no significant incentive, they'll ignore us. If they'll ignore us, then we'll consider it as an outright sale with the right of return. We'll record it as an outright sale, but we'll give a clause that this has a right of return because the customer has this put option wherein they can require us to repurchase. So if there is no significant incentive to the customer, we'll consider it as an outright sale with the right of return. In second scenario, there is a significant incentive to the customer, but the price is lower than the original selling price. What will it be? If there's an incentive, definitely they'll want us to repurchase it. And if they want us to repurchase it, we received 7 lakh, but we paid only 650. And we repurchase that asset. If we repurchase the asset, what is this differential we received for? What is this differential we received for? Leasing arrangement. Perfect. Now what we are getting it. So this will be treated as a lease under IFRS 16. In third scenario, we were funded for 7 lakh and they'll require us to repurchase because definitely that gives them a significant financing component, significant incentive. They'll exercise the option. And why we would agree to pay more? We agreed to pay more on repurchase because we actually entered into, what is the third scenario? We actually entered into financing arrangement. So the only thing which you need to take care of between the two repurchase agreements is that if the repurchase price is lower than the original selling price, in case of customer having the right to repurchase, customer obligated to repurchase, it is a leasing arrangement. But if the repurchase price is higher, it is actually a financing arrangement. Even if the customer has the right to get us repurchased, if they require us to repurchase, if the original selling price is higher than the repurchase price, it will be a leasing arrangement. If the original selling price is lower than the repurchase price is higher, it is a financing arrangement. But we need to take care of the incentive. That do they have incentive, significant incentive in it? If they have no significant incentive, then in that scenario they'll not be engaging into this arrangement and we can consider it as outright sale. So these significant incentives are already known in advance. When we enter into these arrangements, the market is so open that these incentives and these prices take care of those options in future, that what can happen. They'll enter into second and three because they know that they'll be having much benefit. So they are actually entering into a leasing arrangement and they know the pricing in the market. It will be beneficial for them to repurchase it, require the customer to repurchase it, and customer will be happy because they also wanted it. They also got into this arrangement because they were only interested in the right of use amount, the lease amount in the form of 50,000. The third party, when will agree to pay higher price, it is all because the party is only interested in getting them funded and they are ready to bear this additional 50,000 in the form of financing arrangement. Why it is linked to incentive? Because now we are saying that the customer has the right to require us to repurchase. We may not repurchase it, we may not agree to repurchase it, but since the customer has the right to require us to repurchase, he will be given the benefit of incentive this time. That if he has incentive of requiring us to repurchase, that will be either resulting in a leasing arrangement or financing arrangement. If he doesn't have any significant incentive, we'll consider it as a sale. He'll not come back to us.
Amit, just I think I missed something. In the scenario B, what is the incentive here? As it looks similar to the first one.
Which one?
In the scenario B, what is the significant incentive here?
Significant incentive is that if they sell it in the market, they'll be able to sell it only for 6 lakh. But if they require us to repurchase, they are able to require us to repurchase at 650. That is a significant incentive in comparison to the fair value in the market.
Okay, got it.
So in the first case, the fair value in the market had no significance because the arrangement was such that definitely we wanted to get into leasing arrangement or either we wanted to get into financing arrangement. This is quite simple. When the customer has the right to repurchase, when the customer is obligated to repurchase, they're obligated to repurchase means they will be entering into this transaction. They know it in advance. When they have the right to repurchase, they'll definitely exercise it only if they have significant incentive. And significant incentive will be when they are able to repurchase it at a lower price than in the market. So this will exist. Definitely the pricing will be such that we are going to exercise this option and we will bring back the asset back into a position after allowing that customer to use it for some period of time. And when we bring it back, we actually earned it in the form of right of use. So this 50,000, we earned it in the form of right of use. We received 7 lakh, but we paid back only 6 lakh 50,000. This 50,000 we earned for entering into right of use. Here, since the right is with the customer, now it is not in our control. These two were in our control, whether we exercise this right or not. And when we entered into these arrangements, will not bear any losses. So we know that if we are required to pay more, we are actually being funded. We are required to pay less, we are entering into a leasing arrangement. This is quite clear to us on day one as the party who is actually having the right to repurchase and having the right to, or either we are obligated to repurchase. When we enter into obligation to repurchase, we know that we'll have to pay more than the original selling price. And if you have to pay more, it is a financing arrangement. When we have the right to repurchase, we'll exercise this right to repurchase only when we know that we have to pay very less and the fair values in the market are significantly going to be higher. Then only we'll get into this arrangement. The second scenario is when the customer is requiring us to repurchase. The customer will require us to repurchase only when he'll be in a position wherein he's going to benefit from it. If he's going to benefit from it, he'll definitely come back to us and will require us to repurchase. And we are also very clear that why he'll come back to us, because we know that we enter into a leasing arrangement. If it is beneficial to him by chance because of having this right, he'll not come back to us to demand us to pay 650 because he's getting more in the market. So there's no significant incentive to the customer to require us to repurchase now because he's getting a more benefit in the market. So we'll consider it as a sale that the customer will not come back to return, but it still has a right of return till the period this right exists. So if he's getting less from us, it's a leasing arrangement, is getting more from us, we're actually also paying the interest component to him for funding us for 7 lakh. Clear?
Amit, in this case, in both the A, B, and C scenario, the fair value is less than the original selling price. So is it right to assume that in this kind of case, fair value will always be less than the selling price? And if it is higher than the selling price, then it will be the right, it will be like the call option.
So if I try to make the fair value higher, if the fair value is higher, he'll never come back to us.
Yes.
In A part. If fair value is higher in this scenario, again, he'll never come back to us.
Correct.
Isn't it? But
Yes.
since fair value is lesser and what we are going to pay is more, there's an incentive to require us to repurchase. If fair value was 7,50,000, he would have never come back to us. So there was no significant incentive for the customer to require us to repurchase. If the fair value is lesser and what we are paying is more, there is a significant incentive. That's what significant incentive means. To require us to repurchase. Getting the point? And if in the third scenario again, if the fair value was 720, there is a significant incentive. Even if I make it 720 here, even then he'll want us to do it, and we are ready to pay more because, but practically speaking, the original selling price cannot be more unless it is a land and building. It can be more in the market. The fair value in the market will be 720. But if there is an incentive, significant incentive to the, I should write it here, significant incentive to the customer, even if the price is higher than original selling price. Only if he has incentive, he'll come back to us. And if he'll come back to us, this is actually a financing arrangement. That means we had agreed to pay much more than whatever the price in the market could be. Agree?
Yeah.
And first scenario, if the price is 675 or price is more than 7 lakh or price is more than that, that means we are going to pay lesser than what he's getting in the market. So there's no chance of him returning to us because there's no incentive of, there's no benefit for the customer to require us to repurchase. He'll exercise this right only when he has benefit in comparison to market prices.
Got it.
Clear?
Thank you.
And Amit, in case we have a contract with the customer that after a certain period it will be repurchased at the fair value of the market. So it will not be, I believe, it will not be recognized as sale as in revenue.
So if you say that it is exactly same, you mean that customer has the right to require us to repurchase exactly at 675,000. That's what you mean?
Yes. Yes.
So it will depend on the customer now, because he'll have incentive anyway, whether he's selling the market or whether he sell it to us.
Yeah, but it should not be considered as sale, as we have not transferred the risk to the customer in that scenario.
Even in this scenario, if the customer has, even if he sells to us or even if he sells to someone else market, but he's not obligated to sell it to us, there's no incentive to him, so we can still consider it as outright sale with the right of return, that he can return it to us, may not return it to us. Is the reason the term used is outright sale with the right of return. So we'll consider it as a sale, but there is a right of return. He can come back to us as well. He may sell in the market, he can come back to us, even if we keep the prices as same. If the fair value in the market is same as what we will give him, so he has the right whether he can sell it to us or whether he can sell it in the market. So we have no chance of recovery because we are not in this situation. If we are in this situation that we have the right to repurchase, then it's leasing. If we are obligated to repurchase, the other party would give it to us because they're not interested in the item, they're more interested in the interest income. So definitely they'll require us to repurchase, and we will also be willing to obligate to repurchase because we have given away our ancestral property to them in the form of collateral, and we would also be obligated, we would want to repurchase. In this scenario, we are calling it outright sale, and if I agree to your pricing, then it's not necessary that customer will want us to repurchase because we have no right now. So that's why it's divided into two parts, where we have the right to repurchase, where we are obligated to repurchase, where we do not have the right to repurchase. If we do not have the right to repurchase, it will depend on the now significant incentive. The second scenario is when we don't have the right to repurchase, we do not have any obligation to repurchase. It depends on the third party now, whether they'll give it to us or not. So it totally depends on the significant economic incentive to them. If there is incentive to them, in this scenario, no incentive to them, whether they sell it to us or no, there's no difference now. So we'll still consider it as outright sale. But here there is an incentive to them that if they sell in the market, they'll get 6 lakh, but if they sell it to us, if there is incentive to them, they're bound to come to us. They'll require us to repurchase. If they require us to repurchase, it's actually a financing arrangement. And if the incentive is much more than the fair values in the market, definitely they are going to require us to repurchase, and we know very clearly that the benefits we are going to do are much more than the fair value in the market. So this is clearly a financing arrangement. So it totally depends on what is the situation with the customer who has the right to require us to repurchase. Clear? So if Bhanu, if you think of something opposite, that opposite is the other part. This is the opposite of what we can think.
Yeah, I was thinking of that. Can't it be a case of the inflated sales showing that like the risk has not been transferred to the customer, but we are showing is at the 700,000. The sale has happened, but we reserve the right of getting it back over after a year
Yeah,
at the market price.
you only wanted me to. So definitely practicality of the situation will come into play. So we see we be mathematicians as well as we also want to do principle based accounting. Okay. So the moment we try to become mathematicians, we play with figures. But once we played with figures, we lost sight of the principles of accounting. Definitely, it can be unfairer in some scenario. That why would someone agree to be sold at 7 lakh when the fair value in the prices in the market can be lesser than it? It may also happen that in future the prices may decrease, isn't it? Panu.
Yeah.
When it was being sold, it was 7 lakh, but in future the prices may decrease.
Yeah.
It can happen. But if the prices decrease in the market at 650, and if they require us to repurchase, they'll get 675. What they'll do?
Yeah, they will get back.
They lease back. Definitely. So definitely this should not give them any significant incentive of requiring us to repurchase. So I'll reduce the price to 6 lakh. Okay. Or if you want it to be fairer in the market, let's increase the price to 725,000 for the fair value asset in the market. There's no chance of them coming back to us.
Yeah, certainly.
Now this is also, I think, meeting the requirements of mathematics as well as principles of accounting and ethics in the industry. I guess, right? This is meeting.
Yeah, thanks.
They'll not require a repurchase at 6 lakh. We'll be more than happy to buy it. So since there's no incentive, it will be considered as an outright sale, but with the right of return. Depending on the pricing, the market can change. Hope this is clear. This is complex to understand, but once you think from the perspective of you, if you would be in that situation, what you would do, then I think life may seem easier for you. Okay, always place yourself. If you would have got into this arrangement, what you would have done if you were on the customer side and if you were on the buyer side. Clear?
Amit, my question is also more on in the line with what Bhanu asked. Like in this second scenario, how the accounting will be done? Like say, because the ball is in customer's court, initially we will recognize it as a revenue, right? In first step.
That's what we are trying to see.
Yeah.
That what is it? Whether it is a leasing arrangement, whether it is a financing arrangement, whether it is a sale. So in these 4 scenarios, it will not be revenue in any scenario. 1, 2, leasing or financing.
No, not 1 and 2. Here in second
leasing,
scenario,
only in case of scenario 1, it can be outright sale.
That will be outright sale.
Only in scenario 1, we can recognize revenue. In all other scenarios, we will not be able to recognize revenue. That's what we are trying to portray. That it is not a sale, it is actually leasing arrangement. It is not a sale, it is a financing arrangement. We received money, so we'll show it as our liability, cash to liability, and we'll show the leasing arrangement wherein we have a right to use that asset. You'll be earning income over time for the right of use in case of leasing. Because we are earning 50,000 over a period of time. Here we are bearing interest expense. In one case we are bearing expense, in one case we are earning.
That's fine. But say in this second scenario and situation B, okay, where because the customer has to take a decision. Initially, when we sell the goods to the customer, that time we don't know whether he will come back or not. So that time, how we will do the accounting?
So in this case, it is the fair value of the asset has no significance.
No, I mean not in first scenario, but in second scenario, because in second scenario, everything depends on customer's.
So in first case, it is clear.
First case is clear. Second scenario, yeah.
In second scenario, we know the prices which the customer can require us to repurchase.
Yeah, but like in case B and C here, we don't know whether customer will come back or not. So I mean, how to decide when we
We will
initially
not
say that?
recognize until that uncertainty is clear, and if we are able to project those prices in future, we'll definitely recognize sale with right of return, because this is not clear.
Okay,
See, these two
okay,
scenarios will be clear. See, B and C will be clear.
okay, okay. Yeah.
And
So
third scenario will not be clear means we can predict, and we'll recognize revenue only if we believe that the significant reversal of revenue is not possible. So this is possible when we know that the customer has the right to repurchase at a very significant lower price. We are paying 7, and when the price is very low and we know that the prices in the market of this product are going to be higher in
okay,
future, definitely it will be a sale.
okay, okay.
Because if we are in the second scenario, then definitely we know that it is a leasing arrangement. Even if you're in third scenario, we know it is a financing arrangement. The only uncertainty will be in this scenario whether he'll have significant benefit or not. So if we know that he'll have some significant benefit, if he'll have no significant benefit of requiring us to repurchase, we have sold it with the intention to sell it.
Hmm.
Our intention is to sell it, but we have given them the right to return just to maybe lure them into this sale that you have the right to return.
Okay, okay,
But our intention is of selling. Our intention is not entering into leasing or financing arrangements.
okay,
So that's
okay.
what it is trying to pull out, that what is your intention, whether your intention is to get into a lease arrangement, or your intention is to get into a financing arrangement, or your intention is to get into a sale where you want to give the customer a right to return, because that is actually initiating that sale. That right to return clause is actually helping that sale.
Mm-hmm.
So you're not willing to get into leasing or financing arrangement in the scenario 1. You want a sale to happen.
Yeah.
Okay. And if I talk from our perspective, we do not want the sale to happen. We are entering into these repurchase agreements because we want it either to be leasing arrangement, or we want it either to be a financing arrangement. We don't want sale to happen. That's the reason it is wanting us to see that in most of the cases it will be either leases or financing. Only in one case it can be sale, and when there is no significant incentive, and will be very clearly known when we enter into this kind of arrangement, we'll know that the customer will not have significant benefit out of it.
Mm-hmm. Okay.
Is the reason we are getting into this. Okay.
Yeah.
So the people who are in this industry are very clear about what they are entering into. Whether when they decide the pricing of it, they are very clear whether they want to give the customer any incentive or not in future. Okay. And if they want to give them some benefit of higher financing, if they want to give them some benefit, if they'll repurchase, definitely they know that the prices will be lower in the market, but they will want to repurchase simply because they want to retain the ownership of that asset, and they have given away this asset only for some period of time. So they know in advance that by paying more than the fair value, they are actually able to recover back their asset. In this scenario, they don't want to recover.
Mm-hmm.
So definitely the clauses will be such that they'll be in a favorable position. They're trying to be in a favorable position. It may happen or not is future, but for them now their intention is to sell. So accounting is always from the perspective of the intention of the management, what they actually wish to do, and they'll enter into those arrangements which will actually meet their objective. They want to sell, they'll get into first arrangement. They want to get back their asset, they'll get into second arrangement. They want to get funded and also want to retain the ownership of the asset, financing arrangement. In this scenario, the third scenario, they may not even give the physical position of the asset to the customer. Wherever there are financing arrangements, they may not even transfer the asset to the customer, because it is actually acting as a collateral security. So they know what they are doing in substance. Okay. But these arrangements exist which require to be comprehended by accountants. On the face, it looks something different, but in reality, they know what they're doing, isn't it?
Yeah, I think commercial department, when they enter into contracts, that time they will factor into all this most possible
They will,
scenario.
they will definitely, because without factoring into all the scenarios, they may be at the receiving end, they may lose their property.
Yeah.
Isn't it?
Yeah.
They would not like to lose their property. And if they wish to sell something, they'll enter into this kind of arrangement that they don't want a return on it. Okay.
Yeah.
So in first case, this is something which is your operating activity sale. This is something which is your ancestral property, you're emotionally attached to it, you will not like to give it away at any cost. This is something which is a spare land and building which is available with you. You're not using it as part of the business, you can give it on lease. 3 scenarios, isn't it? What you are trying to sell. 1, your land and building available for leasing. 1, you want to initiate a sale. 1, you have an ancestral property which can give you some funding, but you do not wish to give away because you're emotionally attached. 3rd scenario. But customer is stronger in this scenario. Maybe he'll have to bear more money. If he wants this right, he'll have to shell out more money, isn't it? When we retain the rights, we bear the cost of retaining these rights. Agree? So you will not give away the rights. Only when your gearing levels are high, you'll get into this situation. Otherwise, you will be in the first 2 scenarios of funding. Get it? So all accounting is very much related to the stage of the business as well, and the arrangements are all dependent on what is the stage of your business, where you are, whether you are at the receiving end, whether you are in the place where you can benefit out of it. Okay, hope this is clear. When you do it, actually, when you try to do some questions relating to it, when you read it again through the content in the book, I think it will be more clear. On day 1, it is difficult to comprehend this. So don't worry about it, that if you don't understand it in the first place, when you internalize it, when you think as a customer, when you think as a seller, when you put their hat or be in their shoes, I think you'll be able to better understand it. That if you would have been in this situation, would you get into this? And definitely you'll want all these facts and figures, projections of fair values, now price, now projections of fair values in the market. Definitely you'll have all these figures available with you, on the basis of which you're going to take a decision before entering it. You'll not outrightly get into it. So no decisions are blind in business. They are all based on facts, forecasting. Management does take decisions on a lot of things. Okay. So this is all for the standard on revenue. If you have any questions, please ask.